So I'm taking you risk management now. So what is risk management? We see that risk management is a process of limiting or eliminating different types of risk related to Forex trading. And in Forex trading, we take risk in order to make profit. And that's a fact. Anytime you enter a trade, anytime you execute a trade, it means you're willing to take a risk in order to make a profit. So, and each time a trade is taken, the trading account is exposed to risk, and that's a fact. And all businesses have one form of risk or the other, and the level of risk varies depending on the nature of the business. Some businesses are high risk, while some are low risk, and that's just a fact of life. Every business we do has a form of risk or the other, but the level of risk varies from one business to the other. And we say that for all businesses, however, the higher the risk, the higher the return. So if you want a business with a high return, it means you're willing to take a high risk. If you want a business with low return, it means you're willing to take, lower risk also. So how do you apply risk management in Forex trading? Number one is what is called position sizing. Determine the appropriate size of your trade position based on your account size, risk tolerance, and specific trade setup. A common rule of thumb is to risk no more than 2% of your trading capital on any single trade. Now, this is very important. You should take note of this. This is an example. An account of $1,000 with a risk of 2% per trade, which is $20. $20 is the 2% of $1,000. So if you are risking just $20 out of $1,000 per trade, you will require 50 consecutive losing trades to deplete that account of $1,000 compared to an account of $1,000 with a 10% risk per trade, which is $100. This will require 10 consecutive losses for the account to be lost. Now, this is the reason why some people easily blow accounts. If you are risking more than 2% of your account per trade, the chances are that you have less, you have a high risk on that account, and in a matter of time, you will blow up that account. Because if you're risking just 2% out of $1,000, it means you're risking $20. You will need 50 consecutive losing trades to blow that account. But if you're risking $100 per $1,000 account per trade, $100 per trade on a $1,000 account, with a consecutive loss of 10 trades, that account will be blown. So you need to, one of the important things in risk management is being able to know the amount of your capital being at risk per time. And that's a function of the lot size you are using to trade. One of the ways you can know this is through what is called the position size calculator. You can make use of that to know the percentage of your account that is at risk per time. And if you don't know the percentage per time, just stick with the specific lot size for your account. For example, if you're trading an account of $10,000, you are not expected, you can still use a standard lot for $10,000. Never use a standard lot for any account that is less than $10,000. You will lose that account in a matter of time. If you're trading a $1,000 account, the highest lot size you can trade with $1,000 is 0.1 lot. And any account less than $300, never go beyond 0.01 for such account if you want that account to last. And that's just the fact. If you've attended my trainings, I've emphasized a lot on what I'm telling you now in many of the training sessions, that we do have at PU Prime.
Hello, sorry, sir. You are breaking seriously.
Really? That could be network. Can you hear me clearly now?
Okay, yes, it's a bit better now. There's something specific I didn't get. You say if you are using a $1,000 account, what lot size are you recommending?
If you're trading a $1,000 account, don't go higher than 0.1.
Okay.
But please, I think don't ask questions further now, because so that I can concentrate on the class at the appropriate time.
Certainly, sir.
At the appropriate time, we'll give room for questions. Okay, so we'll continue. So other forms of risk management is your stop loss order. your stop loss order. Now, stop loss is a must in trading if you must protect your account. So you must determine a predefined level at which you will exit a trade to limit potential losses. This helps you stick to your risk tolerance and prevent emotional decision making. How do you apply stop loss? Now, this is very important that you take note of. People have a lot of funny ideology when it comes to stop loss. Some believe that a stop loss should not be more than maybe 10 pips. Some believe it should not be more than 15 pips. Now, it depends on the kind of trade you're taking. If you're doing day trading or if you are doing scalping, there are specific stop loss that goes for each of those category of traders. And also, your stop loss can be affected by the kind of currency pair you're trading. The kind of stop loss you will use on Euro USD, you can't use the same on GBP JPY. Your stop loss will be hit easily. If you are putting a 20 pip stop loss on GBP JPY, you are just playing. In a matter of few minutes, GBP JPY has done 20 pips and your trade is gone. You've hit your stop loss. So how do you really apply stop loss professionally? That's what I've listed here. Number one, by using your most recent high or your most recent low. Your most recent high. If you are on a bearish trade, your most recent high will be your stop loss. If you're on a bullish trade, your most recent low will be your stop loss. Number two is that you can use support or resistance level, also that can be used for your stop loss and even possibly your take profit. You can also use the Fibonacci tool, for your stop loss, and you can also use pivot points. Now, pivot points are not indicators that come with the MetaTrader platform. So if you want to use pivot points, you might have to download it online. It's a third-party application which you might have to download independently, but they are equally very good. They are very good, tool that you can use generally for trading and even to determine your stop loss. Now, you can also use your risk-reward ratio. Risk-reward ratio in a reasonable way. Let me put it that way. So meaning that if you're willing to risk maybe 30 pips in order to make a 60 pips or a 90 pips. Now, when you talk about risk-reward ratio, it's usually in a ratio. You are willing to risk a certain amount, an X amount to make a Y amount. Usually, it's best as or the common ratio being used is ratio 1:3 or sometimes ratio 1:2. You're willing to risk 20 pips in order to make 40 pips or 60 pips, or you're willing to risk 30 pips in order to make 60 pips or 90 pips. It all depends on your personal risk tolerance. Then the final one here is that you can also use trailing stop as your stop loss or for your risk management. Trailing stop, comes in two formats. There is a manual trailing stop and there's an automated trailing stop. If you get to your MetaTrader platform on desktop, now this function is not available on mobile yet, but on the desktop, you can find the automated trailing stop on MetaTrader 4 and MetaTrader 5. So if you already have a running trade, you can apply a trailing stop. What a trailing stop does is that it automatically moves your stop loss as your trade is progressing. So you enter a trade, your trade has gone up by maybe 30 pips. The trailing stop can move your stop loss from the initial stop loss to the entry price so that you can lock in some profit. As you go higher, it's also shifting your stop loss higher to lock in profit. So you can do that, using the automated version, or you can do it manually by manually shifting your stop loss each time your price gets higher so that you can lock in some profit. Now, what happens is that if price now reverses back or retraces, instead of you losing the entire trade as price goes back to zero, it will rather hit your trailing stop, the one I have set either manual or automated, and price closes there. So you've locked in some profit and you're not making any loss at all whatsoever. So set stop loss orders, risk reward ratio. I think I mentioned all this. Another thing you can do to practice a better risk management, aside stop loss and risk reward ratio, is diversification. Learn to diversify your trade. Don't put all your capital into a single trade. Diversify your trades across different currency pairs and set up to spread risk. Now, this is very important. Many traders fail to do this. Sometimes if somebody take a trade on GBP/USD, and you will see 20 trades at a go. That is a poor risk management. And some will be showing you, it's funny when you watch some videos on YouTube, somebody takes 10, 20 trades on GBP/USD, and it shows you all of them are blues. But it will never show you when all of them turn into a loss. That is very poor risk management. Instead of putting 20 trades on one currency pair, why not split it across different currency pairs so that you can manage the risk? Because if you put all the trades on just one currency pair, it's just the currency pair. What if it's a losing trade? It means you lose all of the trades at the same time, and that can affect your capital drastically. But if you spread the risk on different currency pairs, maybe you do 2 trades on Euro USD, you do 1 trade on GBP USD, you do another one on CAD JPY, pairs that are not even related, all of them will not be losing trade at the same time if you do your analysis properly. Some will be winning trades and some will be losing trades. And the goal is actually to have more winning trades and losing trades. So diversifying your trade, will put your account, will help you to manage your risk effectively so as to protect your account. Another thing you need to note is to avoid over leveraging. High leverage can amplify both profits and losses. Use leverage judiciously, keeping in mind that higher leverage increases your exposure to market fluctuations. Over leveraging can lead to overtrading, which involves opening multiple trading positions, which can put your account at risk. Leverage is very good, but the downside of leverage is that if care is not taken, it can lead you to overtrading. Overtrading is having multiple trading positions, which I just mentioned earlier. By the time you are opening more than 5, 6 trades at a go, to be honest, you're already overtrading. You're already overtrading. So learn to limit your trades as much as possible. You need just the high quality trades. Any trade that is not of good quality, you don't have to trade it. So avoid over leveraging, avoid overtrading in order to practice a proper risk management. Another thing you need to note is called the risk assessment. Evaluate potential risk of each trade before entering. Consider factors such as market volatility, upcoming economic events, and news releases that could impact your trade. Before getting into a trade, check forexfactory.com to know if there's going to be an upcoming news event. Also check other technical factors like support and resistance. And in fact, as a rule, do not place a new trade 2 hours before news release. This is very, very important. It's good to carry out proper risk assessments before you enter a trade. Before you enter a trade, first of all, confirm if there's going to be an upcoming news on Forex Factory or not. Now, if there's going to be an upcoming news, you need to know, is it right for me to place the trade? Is the news coming up in 2, 3, or 5 hours from now? If it's coming up 2 hours from now, there's no point, because you may enter that trade, the news will come up and go against that trade, and that trade becomes a losing trade. So it's better to just, wait. If you're not going to be trading the news directly, once there's an upcoming news 2 hours before, then don't place a trade. But after the news has been released, maybe some 30 minutes after, and the effect of the news is, wearing out, then you can now place a trade. That will help you to keep safe, in the market. Use of technical and fundamental analysis. Utilize a combination of technical and fundamental analysis to make informed trading decisions. This can improve your accuracy and reduce the likelihood of entering risk with poor risk to reward profiles. Risk tolerance and emotional control. Understand your personal risk tolerance and emotional reaction to losses. Avoid making impulsive decisions driven by fear or greed, as these emotions can lead to poor risk management. Never place a trade out of fear, and avoid taking the trade due to greed. Though I know this one is difficult for many of us. You just want to hammer on one single trade. It's called no other thing other than greed. So you need to understand your personal, emotional reaction to trades, and especially your own personal risk tolerance and reaction to losses. We react differently to these things. For some people, a risk of $10 will shake them when they see a minus $10. To some other person, it's seen a minus 500 and it's not shaking. We are all different. So understand yourself. Don't copy another person. Know what works for you, but most importantly, manage your trades. Avoid fear and as much as possible, avoid greed. And as much as possible, limit your fears when trading. Backtesting and demo trading. Before implementing a new trading strategy, backtest it on historical data and practice it in a demo trading environment. This helps you understand the strategy's risk profile and potential outcomes. So before you start trading a new strategy, it's advisable you first of all backtest and demo trade. Backtesting means on your chart, you are looking at situations in the past where this strategy lines up. So you're backtesting. Sometimes you can backtest in the last 5 years to be sure the strategy worked. Backtest to 10 years, backtest to 15 years. A strategy that has worked 20 years ago, 15 years ago, 10 years ago, 5 years ago, last year will likely work today. So if you have done backtesting means you are just checking on the chart to see that the strategy, is consistent. Now, demo trading now means trading it now on a demo account, practicing it for a minimum of 2 weeks, to be sure that this thing is still delivering. Don't forget you have done backtesting. Don't say because you've backtested, then the next thing is going to live. No, that's not too good. After you've done your backtesting, then do your demo trading for at least 2 weeks. Then if everything works fine in the demo trading, just like you have seen it do well in the backtesting, then you can go ahead and now go into live trading. Also, you have to have a risk management plan. Develop a comprehensive risk management plan that outlines your approach to position sizing, risk limits, trading strategies, and stick to this plan consistently to maintain discipline. One of the most difficult things for traders to do is to be disciplined. But the truth is that if you must go far with forex trading, you must be disciplined. So have a risk management plan and stick with it. Stick with it. No matter what you are seeing in the market, stick with your risk management plan. Stick with your trading plan. You'll be better off for it at the end of the day. Also, you need to understand currency correlation. Understand the correlation between different currency pairs. Trading highly correlated pairs simultaneously can expose you to increased risk. Diversify by trading assets with lower correlations. What does this mean? Currency pairs like Euro, USD, GBP, USD, they are positively correlated because they are going in the same direction most of the time. So if you take a trade on Euro USD, take a trade on GBP USD, take another trade, let's say a buy trade on Euro USD, GBP USD, another bullish trade on AUD USD, another bullish trade on New Zealand USD, you are only increasing your risk because all these currency pairs have the dollar as a quote currency. If one of them goes wrong, every other one will go wrong, and that means you're losing 4 trades because you're trading positively correlated currency pairs. So what do you need to do? You trade pairs that don't have serious correlation. Okay, you take a trade on Euro USD, you take another trade on CAD JPY. They are not related in any way. So both of them will not be wrong at the same time. You take another trade on GBP New Zealand. It's not related. So trade less correlated pairs. That's where you can also manage your risk. And here we have keep your emotions in check. Emotional trading can lead to impulsive decisions. Stick to your trading plan, and if a trade goes against you, don't let fear or greed drive your actions. Emotionally detached trading is a key component of risk management. So always keep your emotions in check at all times as a trader. If you want to last in this business, always keep your emotions in check. Don't take impulsive decisions due to emotions. Take logical trading decisions. Wait for some parameters to line up before you trade. Don't just say, oh, because I see a bullish candlestick, then it means the market is buying. That's an impulsive decision. What other underlying factors can you see that can help you decide that truly the market is buying? Any candle can be bullish or bearish. That doesn't mean the market is buying. Are you seeing any pattern? Are you seeing a support or resistance? Are you seeing a psychological level? Those are things you should look out for. They will override what you are seeing on the candle at the end of the day. So don't take a trade out of emotions. Take logical trading decisions. And finally, regularly review and adjust your strategy. Periodically review your trading strategy and adjust it based on changing market conditions. What works in one market situation may not work in another. So adaptability is crucial. Now, the truth is this: the market is always very, very dynamic. So even though you have a strategy, you may need to review that strategy from time to time. You may need to fine-tune it. You may need to add additional rules, because a strategy may give you some result in a trendy market, and in a ranging market, it may just be a flop. So you just have to know how to regularly review your strategy and adjust it to changing market conditions. Market conditions will always change. The market condition in January is different from what we have in August, September. The one we have in December is different from the one we have in March. So you must be able to always review your strategy so that it can adapt to each changing market condition. All right, so that will be all from us tonight. Tonight, we've looked at two crucial topics. We've looked at psychological levels, and we've looked at risk management. So if you have any question at this point, the floor is open. You can ask your question. You can unmute your mic to ask a question, or you can type it in the comment section, and I will respond to you. Don't forget, we're having the last session of this training on Sunday. We're ending it all on Sunday. Don't miss it. It's going to be another exciting time with a very powerful topic to round up what we started 6 weeks ago. And if on the platform you're new, this is PU Prime. Our head office is in Australia, global head office in Australia, and we have 2 offices in Nigeria, Abuja and Lagos. The Abuja office is the head office for Nigeria, while the Lagos office is the regional office. We have physical training at these 2 locations every Tuesday and Thursdays. If you live in Abuja and its environment, our Abuja office is at Work and Connect Building 50, B2 Ukiwe Street, Jabi, Abuja. And our office at Lagos is at number 54B, Adeniyi Jones Avenue, Lagos Business Executive Lounge at 54B Adeniyi Jones Avenue, Ikeja, Lagos. So you can walk into any of these offices, to make inquiries or to do business with PU Prime. All right, I have 2 questions here. One is saying from Sarah, please, how to trade the different Fibonacci levels. Wow, unfortunately, time will not permit me to go into all that tonight, but definitely there are, if you go on YouTube, there are many ways to use a Fibonacci levels, but what I personally use it most often for is to identify your take profit level. For me, that's the most important thing. I use it for as an addition to my trading strategy. I use it to identify take profit levels, and also you can use it to identify stop loss level. Usually, Fibonacci 50 and 61.8 are the key levels on the Fibonacci tool where there's the possibility of a reversal. So they are usually used as take profit level. Price can either retrace or reverse when it gets to these levels. So you can take note of that. So the other person is asking, what's the best strategy to trade gold? There is no straight answer to that question. You might have to find what is suitable to you, but there are many strategies. See, there is no bad strategy out there. The only thing is that sometimes some strategies don't work during certain conditions or doesn't work well on certain instruments. But trust me, no strategy is bad. If you put together the right tools, you will get a good result. So if you follow our analysis at PU Prime, you'll get how we trade. What we use in trading works across board. Price action, order blocks, they all work for all instruments, including gold. So just follow how we trade and you'll get a good result. All right, somebody was trying to talk the other time, you're muted. I don't know if that person is still available. All right, so how to spot support and resistance on time frame. Okay, that's Tohib. Now, support and resistance levels, I will just oblige this. Support and resistance levels are levels where there's a possibility of reversal, on the charts. So when price hits a resistance level, we expect a reversal to the downside. And when price hits a support level, we expect a reversal, to the upside. Now, I'll take you straight now to MetaTrader. All right, so I'll take you straight down to MetaTrader and we'll cite examples of this support and resistance levels, just so I can answer Toib effectively. So this is my MetaTrader platform. Now, this is the US oil on the weekly time frame, and we can identify a support level right here. So what support level means is that when price hit this level and price is unable to break out below it, you can see the second time price hit the level, we see price go in the bullish direction. Price touched the third time, and you can see a reversal. Now, price is touching it again today. Let me just give you a heads up. I'm expecting a bullish movement on the US oil for next week because price is closing on that same support level as we speak now. Now, that level is not just a support level, it's actually a zone because here we have another support line, which is a combination of this region and this region. So when price hit the level here, we saw a bullish breakout. So also here, price is closing on that same region also. We're expecting a bullish movement next week. So it's a level that price got to and could not break below. That's a support level. For a resistance level, it's a level that price got to above and got to and could not break out above. So here you can see this line. We have a resistance level here, a resistance a second time, and we see price dropping into the bearish direction. A third time, price dropping to the bearish direction. A resistance the fourth time, and price is dropping to, the bearish direction. So at resistance level, we're looking for opportunity to sell, and at support level, we're looking for the opportunity to buy. So I hope that answered Tohib Ojubanire. All right, I'll take a last question as we close. Any question on risk management? Do we all understand? You're welcome, Tohib. Do we all understand what we did on risk management? All right, don't forget the link to this video will be available on our YouTube channel. You can just go over to the YouTube channel to watch a lot of the videos of what we've been doing at this bootcamp in the last almost 6 weeks. Yeah, just go to YouTube and search for PU Prime Africa. PU Prime Africa. I'm typing it in the comment section. You can pick it up there. Type for PU Prime Africa, and I just typed it down. And our channel will pop up, and you can watch all the videos of this training session. It will help you a lot to become, better traders. Thank you, Mr. Michael, for that response. That's, very well understood. I appreciate that. All right. So with this now, we'll come to the end of this training tonight. Take care and have a great weekend ahead. Bye-bye. You're welcome, Macaulay. Thank you, Mr. Joshua.